I'd like to introduce a very special guest with us today, Ryan Miller. He's an independent trader that specializes in Forex, commodities, a little bit of options. And Ryan, we spoke briefly off camera. We started with a little thread in Twitter, and
Yeah,
it's just amazing how the FinTwit community really does align like that. So it's really a pleasure to have you on and touch on perspectives that you have and touch on your blog and a bunch of different things today.
I appreciate that. It's a pleasure to be here. Thanks for inviting me.
Of course. So, let's kind of dive into your journey, from beginning to current. How did you start? What was your motive to begin with? And, has that same motive sustained? Has it changed? What's your story?
Yeah, so I guess my story is a little more unorthodox than most you're going to find in this field. I don't have a economics background. I don't have a finance background. Didn't like school. I was a history major. Played soccer after college. There's only so much you could do with a history major. Didn't want to be a teacher, so I always had an interest in kind of the markets a little bit. Ended up getting a job at a brokerage firm. You ever see the movie Boiler Room?
Yeah, for sure.
Yeah, that's basically where I got going. And, at a boiler room type firm, got my licenses and kind of left. Figured I'd then go be a financial advisor of some sort. And I found I didn't really like that side of things. Just kind of selling securities and whatnot just for the sake of doing it. I don't know. It just wasn't me. And so I started trading while I was there. I figured that was my kind of way out. Right. So I started with stocks initially, and then by early 2017, I got into Forex, and I've been trading mostly Forex ever since, and a little bit of commodities, mostly like gold, silver, and then a little bit of options as well. But yeah, started off with stocks, transitioned into Forex, and that's kind of what I've been trading since. So started out with just, most people get involved, it's just money, right? I just want to make a lot of money, and that's actually what hurt me as a trader. Just focusing on the money. So it's kind of a long journey to find some sort of success. But yeah, now I trade for myself, and I just enjoy kind of the macro. So I'm a day trader, right? I've always day traded. I've been day trading for almost 6 years, and I more recently started diving deeper into this macro side of things and kind of taking my trading to that part of it as well. Instead of just day trading, I'm looking to, trade this whole kind of take this macro approach and trade it as well and hold on to assets days, weeks, maybe months, which is a little different than kind of constructing a portfolio. But, I'm a trader, so that's what I do. And then I have my website, Ryan Miller Trading Economics, where I just kind of talk about the markets, my perspective, talk a little bit about macro, what's going on, just kind of share my thoughts and opinions. And that's kind of where I'm at. And we'll see where it goes from there.
That's great. It's a really great story, and it's really inspirational to those that are just beginning out. I mean, because some people, for those that believe, you've heard the phrase or the question that everybody asks, do you believe time is more valuable than money, and vice versa? A lot of people are materialistic, especially in today's commission-free trading ages. And the entry to barriers in trading are much, much easier than it was even just 3 to 5 years ago. So
Yeah.
It's crazy how things are just exacerbating in terms of, technological progression. That reminds me, I'd like to ask, so you focus intraday primarily in trading, or is that your primary time frame?
So I day trade every day, right? I mostly day trade Forex. Most people who trade Forex don't day trade Forex. I happen to know a lot of people that do, but most think of Forex as more of a longer term kind of swing position trading type thing. But I day trade Forex every day. And then I also, once I'm done trading, I'll trade for a couple hours or so. Then my focus is kind of on the macro side after that. What's going on in the markets? Where can I find, discrepancies in the markets and look for bigger moves where I can, get into an asset instead of just getting in and out, look to hold it for days, weeks, months, whatever the market kind of gives me. Right. So I'm trying to, instead of having a portfolio and, you have a diversified portfolio, maybe this side's not doing so well, but then this side is doing well and it kind of balances out. I'm looking to just find these bigger moves in the market, trade them, and that's it. I don't like to sit in assets and just, watch my money just kind of sit there, or even just sit in losing positions for a long time. I don't like to do that. So if the time's not right, I'll just be in cash. So I find an opportunity to get in, get out, depending on, like I said, days to months, and look for the next kind of opportunity.
Right. Yeah. I love what you said, like give what the market gives you, or take what the market gives you. That's just,
Yeah,
why force a trade when you can just wait for the opportunity to arise?
exactly.
Yeah. So,
And there's give and take to that, right? I mean,
right.
sometimes you're focused on, because you can't time everything perfectly. That's for sure. A lot of times you can't get the timing right. And if you have a portfolio and you're in X amount of assets, maybe you're in gold, right? You're not really paying attention to what's moving gold, and gold has a big move. It's like, oh, well, you caught gold. It's like, well, if I as a trader, I'm not in gold. I'm waiting for the right opportunity, the timing. If I get the timing wrong, maybe I missed the move,
Right.
right? But I also, if that thing goes against me, I'm not sitting in a losing position for a while. So there's give and take to it.
Do you follow primarily, really with any asset class, really, but do you follow, for example, gold to copper ratio or the gold to silver ratio, any of those kind of ratios, or even, like XLE over XLF kind of thing? You know,
Um, yeah, and, I do a little bit with kind of the gold silver ratio. So I'll pay attention to that. If I think for whatever reason gold and silver are going to, say, they're going to rise, and I find silver to be a lot cheaper than gold, and maybe I'll purchase more of silver than gold,
right.
right? But other than that, I don't do too much with the ratios right now, at least. When I'm looking at gold, for me, it's more of a little bit of the dollar and real rates. I'm really paying attention to kind of real rates and what they're doing, because the inverse relationship with gold and real rates is pretty strong. So I'm really paying attention to that.
Yeah, and that's perfect, because I'd love to dig into your most recent article. I have here, it's from March 11th, 2021, and it's titled Rising Yields and Their Market Implications. And you can find that on the website. Remind me what the name of the website is?
Yeah, so you can actually find me two places. You can find me on fxstreet.com. All of my articles and whatnot get posted there. And then my website is rmillertradingeconomics.com. And you
All
can
right.
find all the same stuff there as well.
Of course, we're going to have all of that information at the link in the description, so it'll be as easy as a click of a button for the viewers to get to see your articles and your work. And so your most recent one, you talked a bit about, the potential scenario where if the 10-year goes to 2%, if the 30-year goes to 3%, which frankly, I think the 10-year hit a high of 174, 175 maybe.
Yeah,
So
give or take.
give or take, I mean, we're kind of inching, we're making higher lows on the 10-year, and the 30-year is just, consolidating, is trading sideways, but in a much more volatile way. So what is that telling us across the yield curve? Because we saw the worst ever 7-year treasury auction like ever. I mean, the bid to cover was pretty much just about at 2 or 205. So there's no demand, especially from the indirect bidders. So, I mean, there is demand, but it's clearly decelerating. So what can be said about the action across the yield curve now?
Well, I might be a little more concerned if that was like the 10 or the 30-year auction. But
Yeah.
no, the seven's still important, the kind of the belly of the curve. But I think on the long end, the 7, the 10, 20, 30 year, that's selling. I think it's just kind of right in line with with the inflation expectations in the market, this kind of reflationary period that we're in right now, since for the last several months, really since I guess kind of May, June of last year, right? When the stimulus really started getting rolled out. Yeah, we've been in this kind of reflationary period, and I mean, markets been kind of all in on it. It's really one-sided. I mean, you've seen some of the heaviest short positions on, say, the 30-year treasury in history, or close to the heaviest net speculative short position on the 30-year treasury in history. We've seen copper just, kind of off the charts. Oil's rally from the bottom has been pretty crazy. Equities continue to make kind of new all-time highs. So the inflation expectations, there's expectations of economic recovery. I think that part of the curve, the long end, is kind of right in line with that. The short end might be telling a little bit of a different story, but the long end is, I think it's just kind of right in line with market expectations right now, at least.
Right. Yeah, you mentioned the short end of the curve. I mean, 3-month bills and, all those short-term notes, I mean, they're barely nudging. And in fact, they're probably going down, right? Relative to 5 years and up. I mean, 5 years duration risk and higher. It's just completely opposing narratives here. But the following question is the reflation trade getting ahead of itself?
That's a $1 million question, right? I guess that depends what side you're on. If you're on the reflation side, then no. If you're not, like myself, I guess you could say more of a deflationist first, right? I see more deflation first, and I think it is getting ahead of itself. Because I mean, we've been here before.
Right.
We've been here several times since 07, 08, since the global financial crisis. Most recently, in 2018, this whole narrative played out: runaway inflation, global economic recovery. It all played out, and it rolled over. And I see the same things kind of playing out now, right? The yield curve steepened a bit. We've had this rise in yields, especially on the long end. Oh my God, everyone's getting crazy. It's all over mainstream media. And runaway inflation, economic growth, stimulus, quantitative easing. Like, I don't know, we've been here before. And each time it is rolled over to the downside. I see a lot of this inflation expectations. Something I like to look at. First off, you have oil and copper. Those are two big ones. People just see oil, copper, they call it like Dr. Copper, right? It's a good gauge of kind of economic health. They see those things rising. It's like, oh, that's evidence. Reflation is here to stay. Economic recovery is here. It's now. But they don't look at kind of why they've been rising. And I think a big part of that is supply chain disruptions, right? From COVID. COVID kind of shocked the global supply chains, right? And that's a big reason why oil has been rising, on top of, I mean, how many oil production cuts have we seen over the past year, right? Look at same thing that happened with copper. We have supply chain disruptions, and there's naturally been a lower supply of copper. I think there's been forecasts that they expect copper to decrease between now and I think like 2025. I think copper supply fell, I think somewhere in like the 2 to 3% range in 2020. On top of that, China has been hoarding copper. They've been buying big, massive amounts of copper because they're big importers of copper, and they see supply falling over the next few years. They've been hoarding copper, so that's been pushing those assets higher. And then if you look at kind of inflation expectations, I like to look at kind of the 5-year, 10-year like break-even rates. And for those who don't know, they're just basically a measure of inflation. A break-even rate, you just basically take the nominal yield and take the difference to the nominal yield and the inflation protected the yield on the inflation protected security of the same maturity, and you get kind of your break even. So it's just a measure of its expected inflation expectations. So if you look at the 5 and 10-year inflation break even rates, they've been rising quite dramatically, but more recently, the last few weeks or so, the 5-year has actually gotten above the 10-year. So if we were expecting inflation, right, around the corner, and expect sustained levels of inflation, we should expect the 10-year inflation expectations to be higher than the 5-year. What's happening is the 5-year has gotten above the 10-year. I think right now it's like 20 basis points higher. And what that's saying, the market is saying that it does expect some inflation, but it doesn't expect it to last. It doesn't expect there to be sustained levels of inflation in the longer term. And if you look at the 5-year forward inflation rate, which is basically what is inflation expectations in a 5-year period starting 5 years from now. Okay, so longer term inflation expectations, and they're not even above their 2018 highs, which was the last time this whole runaway inflation narrative was playing out. So starting to see expectations kind of give us some signals that inflation might be short-lived, right? And yeah, so I think, like I said, I think same thing's going to happen that's happened since 2008. We get this reflationary period, inflation rises, and then it rolls over.
Right. It sounds about right. I mean, even just look at Japan. They've been doing it longer than us. And, they're just in a continuous cycle of financial repression. And I feel as though, alluding to what you were pointing out, we're just following that very same path in terms of monetary and fiscal disruptions and interventions. And, but that follows the next question, which is, because it's kind of hard to quantify. I mean, in terms of a limit to how much debt, central banks can actually hold. I mean, governments can hold, and sovereign governments, because clearly we haven't breached that limit, because otherwise we'd be defaulting on that debt. But I don't know, I'm asking you, do you think there's a way to quantify, for the US, for example, how much debt can the US government actually handle? Because we're approaching 30 trillion not too far from now.
Yeah, I don't know the number.
It's like 160 trillion in unfunded liabilities. It's insane.
Yeah, I think we're around, like, debt to GDP, like government public debt to GDP is like 130%, right? 130% debt to GDP levels.
Right.
Like I don't know how much higher that can go before something breaks. But here's the thing: this is not just specific to the U.S. Like everywhere else is doing it. Japan's doing it, right? UK is doing it. ECB is doing it. Like everyone else is doing it. If this was just the US doing it, it's like I'd be more concerned, like how much higher can we pile on the debt before, like right. You said, we default, people lose trust in the dollar, so to speak. I don't think we're anywhere near that. And one of the main reasons is everybody else is doing it, right? Everybody else is in the same boat we are. And in fact, a lot of other places, Japan, Europe, they're in worse position than we are. Right. So I think we still have a lot of room to run as far as ever kind of defaulting on our debt. The only problem is the more debt we accumulate, the more we kind of suppress growth.
Right.
Right. You can't grow by spending. Everyone thinks, like, or not everyone, but a lot of people think, government spending, fiscal spending, that's the way out, right? That's the way to recovery. I mean, if that was the case, we would have recovered from the global financial crisis already. We haven't. I mean, 2009 to 2019 was the worst growth period in history. Worst growth period in history. Right? We haven't even recovered from that. Right? And we just keep spending more. It just keeps weighing on economic growth. So this is something that Dr. Lacey Hunt, and he's much better at explaining it than I am. But this is kind of part of his framework that he looks at. And it's he looks at debt and how productive debt has become. So what he does, he looks at the production function. So he looks at how technology is reacting with the three factors of production, which are land, labor, and capital. Land's been pretty stable for quite some time now. I don't think the US is really growing or shrinking in any way from a land perspective. Labor has been declining. Labor market's been declining. If you look at labor force participation rate, that's been declining since 2000, and it's been on an even steeper decline since 07, 08. So that's a deflationary force in the market. And then you have capital, right? The third one. So we've been overusing capital. And so what happens, so debt, right? We've been taking on more and more debt. So what happens is when you take on debt, it's kind of linear. GDP, you get a bump up in GDP, right? And then there's been a lot of studies that once you get to about 90% debt to GDP, once you get to around those levels, something kind of gives, and it becomes non-linear. So we're using debt, right? We get a bump in GDP. As you continue to overuse debt, GDP kind of flattens out. And then as you continue to overuse debt, as we're doing, GDP starts to turn down. And that's what we're starting to see. Not starting, we've been seeing for basically since 07, 08 now. Just keep overusing using debt. And each dollar, when this happens, it's what's called the law of diminishing returns. Each dollar of debt becomes less and less productive. So the more debt you take on now, more dollars are now needed to service that debt. So if you go back to like World War II, I think for each additional dollar of debt that we took on, it accumulated like something like $1.30 in GDP. If you go back like 10 years ago, I think $1 of debt produced something like 45 cents of GDP. It dropped significantly. Now we're under 40 cents. $1 debt, I don't know the exact number. I think it's closer to 30 cents, right? So $1 debt, the more debt we pile on, it's producing less and less in the real economy. So it's become a drag on the economy. So we have some major deflationary forces out there. And that's kind of why I think this reflationary period that we're in is just that. It's just a reflationary period. It's kind of a correction, right? It's a corrective move, and eventually you're going to rejoin the major deflationary downtrend.
Right. Yeah. It's like a simple case of just throwing gasoline on fire. You're putting out a fire with more gasoline in terms of and it's just extraordinary in the whole process. I mean, it could even go as far back to the 70s. It could even go as far back to the 1913 Federal Reserve Act. I mean, since that day, I mean, after JP Morgan bailed out the government, before the Fed Act, it was really just, it was a free market economy. And then the intervention slowly progressed. And then we started seeing deficit spending. And then we started, that trend from there on out to this day at such extreme levels. And, some argue it's sustainable from here on out, so long as, we keep spending those dollars with freshly printed dollars per se. But like you just alluded to, those dollars lose value the more that are printed, the more that are artificially produced and are spent in the economy rather than being produced. So obviously we've seen gold and silver being really the main lags, not only in commodities, but pretty much all asset classes. I mean, they've just been, we saw kind of like a cycle high back in August, right? In gold and silver. And ever since, we've been making lower highs on that trend, and maybe a little bit of consolidation lately, but it's just been not much activity. But my question is, do you think we'll see a pickup in this lag along with the reflation trade?
With gold and like silver?
Yeah.
I don't know. So, I mean, people always point to gold as like this hedge against inflation. Historically, it hasn't been that great of a hedge against inflation. So since last, when did gold peak? In August, late in August of 2020, real rates have started to rise. And when real rates rise, we see gold has an inverse relationship. We saw gold start to fall, right? And now they've real rates have risen again, and gold is, like you said, consolidated, but it's starting to fall off a little bit. Now, I think gold is falls during deflationary periods. I know people, it's a safe haven, but when there's like some type of deflationary shock, like go back to March 2020, gold fell. Gold fell, I think something like 15%. Silver fell too, right? Because a lot of people hold gold. Investors, it's in almost everyone's portfolio, pension funds, hedge funds, money managers, a lot of people hold gold. So when they need liquidity, they don't want to sell gold, but they have to sell gold to obtain dollars they need for debt servicing, margin calls, etc. So gold actually falls in deflationary periods. So gold falling could be a signal that there's more deflation ahead, that it might not necessarily buy this kind of inflation narrative. Right?
Right. Sorry.
No, go ahead.
I was just going to ask quick, do you think there's, obviously considering Bitcoins, I don't know if you follow Bitcoin or not.
How can you not? It's everywhere.
Sure. But obviously, given its exponential growth, both last year and currently, are there people do you think it's a large amount of people, or it's minimal in terms of people actually, instead of buying gold as that safe haven asset versus Bitcoin, are people transitioning from gold to Bitcoin? Is that maybe what causing the lag?
I mean, I'm not a Bitcoin crypto expert by any means, but maybe to an extent, a little bit. I'm sure a lot of millennials are buying Bitcoin instead of, maybe go back 5-10 years ago, they would have bought gold. But the Bitcoin market, what's the Bitcoin market cap at now?
I think it's somewhere around $1 trillion.
Somewhere around $1 trillion. So I think gold's what, like 10 trillion plus. So it's still a fraction of the market. I mean, it's growing, it's getting bigger and bigger. So you can say, to an extent, I think that's maybe played a little bit of a role, but I don't think it's had that big of an effect on it, just because the gold market is still 10 times the size of the Bitcoin market. Right. So I think it has more to do with real rates and the fact that it might not, there's a lot of, so this kind of goes back to, probably don't have time to get into it. I wrote an article more about like the short end of the curve. That's kind of signaling there's a lot of demand for high quality collateral, which is on the short end of the curve, because investors, want collateral in kind of a deflationary situation. So gold kind of falling kind of lines up with that idea. Like I said, we probably don't have time to get into that, but to just answer your question, I think it might have just a little bit to do with it, but I don't think that's a major part of it. I think it's more real rates. I think gold has the strongest relationship with real rates than it does anything else, even the dollar.
Right. So can you tell me, like, for some people, this may be kind of tough to understand, especially if they don't know the difference even between nominal and real rates. But, how can you decipher between rising nominal rates, for example, versus, real rates that are obviously backed up, just switch positive, but nominals are just ripping. So is there an arbitrage opportunity in, the bond market? How do you know what I mean?
Yeah, I mean, as far as an arbitrage opportunity, that's not really my forte, so I couldn't really help you exactly with that. But first, let's just quickly define what is a real rate. So everyone who's not familiar at all, you turn on the news, whatever it is, they're talking about yields rising. The 10-year, the 30-year rate, 10-year went to 1.75%. That's your nominal yield, right? That's the nominal rate. So basically, a real rate is you take the nominal yield and subtract it from inflation. So just give you an example. So let's say the yield is, buy a bond and it's yielding 2%, and inflation is, let's say, 1%. Well, your real rate is actually 1%. So right now we have real rates in negative territory. Like the 10-year is below inflation, right? The 10-year yield is below inflation. So it's actually yielding a negative return. I think it's like negative 70 basis points right now, give or take. Okay, so gold and bonds, right, treasuries are considered, right, safe assets, right? People want to own safe assets in times of, market stress, uncertainty, etc. Now, one pays a yield and the other doesn't, right? So bonds pay you a yield and gold doesn't. So let's say real rates are rising, meaning your return on treasuries is rising, right? And you're a more conservative investor, you want to own the safe asset. You can either buy bond, which is going to offer you a coupon, right, a yield, a return, or gold, which you only make money if the asset rises in value. So obviously, investors are going to buy bonds, right, because it gives them a return. Now, when real rates fall, they fall below inflation, like we saw. The short end of the curve in March went negative, right? So we saw this big crash in yields February, March of last year, and real rates. And there was a shock in inflation too that fell too, but inflation picked up a lot faster than rates did, mainly because of, QE was suppressing rates. That created the opportunity in gold last year. We could talk about that, but so inflation picked up a lot quicker than yields did. So real rates were in the negative, and gold rose. Now inflation is flattened out since the middle of last year. Inflation's flattened out, and nominal yields have been rising. So real rates have also risen. They're still negative, but they're becoming less and less negative. Okay, right. So the returns on them are becoming better. So when the returns on real rates become better, people switch from gold to bonds, and when the real rates start to fall, they go from bonds to gold. That's just generally how it kind of works. So that's, I think, what the relationship we've kind of been seeing over the past year.
Absolutely.
I don't know if that answers your question, but
no, it does. It was very clear. I mean, I think anybody would understand that. And to your point, you subtract inflation from that nominal yield to get the real yield. Some people use, a tip, or other people use CPI. What would you use? Because me personally, I think headline CPI is one of the more fraudulent. I shouldn't say fraudulent. I should say it doesn't capture much of really anything that's used day to day in terms of personal consumption. So there, if you check out like the Chapwood index, that's showing 10% inflation right now, which is literally 9 times of what headline is. So there's a huge discrepancy there, but I'd like to hear your thinking on that.
So I'm not an inflation metric expert by any means. There's actually an awesome video on Real Vision, Stephen Van Meter with Mike Ashton, who's like an inflation expert, and he broke down the different inflation metrics. And he actually, surprising to most people, he actually came to the conclusion that CPI captures kind of broad inflation much better than most people think. Because in there, a lot of people think it's very misleading, it's fraudulent. There's other metrics that are better. He actually, got into the Chapwood index, a couple others, how they're even more misleading than the CPI is. But I would encourage you to watch that video. Very kind of insightful. But everyone's inflation basket is different, right? Everyone's telling me inflation is here, it's everywhere. How do you not see it? Like, everyone's basket is different. I've been buying like the same things everyone points to, like the grocery store. Just go to the grocery store. I've been buying the same things for the past 3 years. I've seen no change in price, no change in the quantity, nothing, right? Like me personally, I'm not seeing inflation. I get somebody else might be. Maybe what they buy has been rising in price. They have education costs. They have maybe more healthcare costs. They have this, whatever it is. I think everyone's inflation basket or personal inflation basket is different. And I think they use that when they talk macro, and it doesn't hold much weight. I pay attention to the CPI, not because I think it's necessarily the best metric in the world, or maybe there's something else better, but asset valuations are kind of priced on that, right? Or kind of like the bond market, particularly, kind of prices itself based on inflation, where the CPI is at. And bond yields, their movement, are giving us our interest rates on consumer loans, on mortgages, on housing, etc. So I think from a financial asset perspective, and if you're going to invest, trade, I think it's more important to look at kind of CPI or PCE, if you want to look at that, the Fed's preferred metric, because that's what asset valuations are based on. If you want to go about, like you said, more day-to-day living and how like maybe you need to change your spending habits, what you buy, what you consume based on that inflation, then yeah, CPI is probably not the best for that, right?
Right.
So it kind of depends what you're doing.
Yeah, CPI, PCE, and that's a good point because that's what everybody's looking at. So it's a really good benchmark across the board, the whole 9 yards.
Yeah.
So Ryan, I mean, I wish we could talk more here, but I think it's probably an appropriate time to cut it off here. I loved our discussion. We should definitely talk about doing this again real soon.
Yeah, absolutely.
But before we do, before we get going, do you want to remind the viewers, where they could find your info? And like I said, we'll have all that in the description so they can view it, right down below.
Yeah, like I said, you can find me fxstreet.com. You can find me on Twitter. So it's just my name. It's Ryan Miller. Ryan, not Brian. People always hear Brian when I say Ryan. Ryan Miller _TE for trading economics. And that's my website, rmillertradingeconomics.com. And you can subscribe to my newsletter. It's free. I just send out write some articles, kind of some market insights, what's happening, my perspective on things. It's all free right now. So, yeah.
Fantastic. Ryan Miller, everyone. Ryan, thank you so much for coming on the show.
Hey, it was a pleasure. I appreciate the invite, and hopefully we'll do it again.
Of course. Thank you so much.